In this video, I'm going to talk to you about a potential fear catalyst that could lead the market to fall. First, I'm going to talk to you about that catalyst. Then, I'm going to break down why fear matters, which you might think, I already know why fear matters. But listen to it and see how potentially this could be a little bit of a tipping point. See what your thoughts are as well, or I'll see in the comments down below. Let's get into it. There is a possibility, and I think this is something to consider as a potential market crash catalyst. Now, I don't want to sound like fuddish, like, okay, here we go, market crash again, right? But there is a serious potential market crash catalyst that we really haven't been talking about, and that is the potential that Joe Biden ends up not nominating Jerome Powell for the Federal Reserve again. Right now, we do expect that Jerome Powell is going to renominate, Joe Biden is going to renominate Jerome Powell. We expect that. And the cool thing about Jerome Powell is we know Jerome Powell, right? We're very familiar with Jerome Powell. We've gone through this entire pandemic with him. We know that he's on the slightly dovish side. We know where he stands on inflation. He thinks it's going to be transitory eventually. He thinks by Q2 and Q3 of 2022, inflation's going to go down. That's going to happen at the same time as the taper completes. And at that time, we'll be able to assess if it makes sense to raise rates at that time or not. And how quickly to raise rates. There are expectations. As of last month, 60% of market participants expected interest rates to go up starting in June. However, we just heard on CNBC that rate is now declining and that the market is beginning to potentially more so believe Jerome Powell that it is possible that rates could go down. Or maybe not rates go down, but that inflation does inflect down in Q2 and Q3, and the necessity to raise rates goes down in the summer of 2022. So that is very clear. And so when Jerome Powell changes his tune a little bit, we can really easily determine, okay, this is a huge shift, this is a slight shift. Like, we know Jerome Powell's really predictable. He's really clear. He's easy to understand. I actually think he does a very good job. Now, how could there potentially be a market crash catalyst? Well, the market crash catalyst, let's see here, would essentially be that if Joe Biden says, hey, I'm going to pick somebody else, the market could temporarily freak out because the market's going to have uncertainty. Every time the market has uncertainty, stocks seem to fall. And the uncertainty would be, what if we get somebody who is a real hawk, who wants to raise rates like crazy starting now? What if we get somebody who's a real dove and doesn't raise rates quickly enough and we end up getting hyperinflation? Fears of both extremes, in my opinion, will happen or be amplified if Joe Biden ends up not renewing Jerome Powell as chairperson of the Federal Reserve. I think the best and smartest thing for Joe Biden to do would be to renominate Jerome Powell because it'll keep stability. And so that's why I say it's smart, because the last thing Joe Biden needs right now is more political instability, thanks to the disaster that we've had on with this infrastructure package and infrastructure negotiations. So, if Joe Biden really cares about the infrastructure package and keeping the economy somewhat, on the skinny path to normalcy, please renominate J. Powell. So the market has this funny tendency about going in cycles of fear. And it's really important to consider that. And my economics teacher back long time ago always said that the stock market is a graph of human emotion. And what's fascinating is every time you look around at our stock market and you look for when were the best buying opportunities, you consistently find that the answer was when there was fear. Think about it for a moment. Last March, we had the recession, the COVID pandemic. That was a massive amount of fear, right? That was an obvious one. Massive amount of fear, stocks go down. Then you think about the summer. People think, okay, COVID's going to be over, everything's going to be good, recovery stocks are going up. All of a sudden, looks like we're going to go into a COVID winter. All the restaurants, hotels, everything plummets to lower levels that we've ever seen before because of fear of the virus, right? That was the winter wave that we had. You look at what happened in October of 2020. It was pure fear. People were fearful that we were not going to have a peaceful transition of power, that we were not sure who was going to be president, we weren't sure what policies were going to get enacted. Massive fear. Same thing regularly happens over and over again. It happened this spring, and people are asking me, Kevin, how do you know? How did you know there was going to be an end of the year rally? People all the time, I'm getting this in the comments all the time, and I don't have a crystal ball. I just made an educated guess. And my educated guess was such that I looked at when is most fear likely to subside. See, we already knew going into like November, December of 2020 that we were going to have massive inflationary fears in 2021. In fact, I wrote a TikTok or made a TikTok about a Bitcoin price prediction, and in it, it was from a course member live stream. We ripped out of it. It was like January 5th or January 6th. And in it, I said, there's going to be a lot of inflation clickbait next year. Inflation's going to go up, but there's going to be a lot of fear, uncertainty, and doubt around inflation. And sure enough, there was. It came a little earlier than expected. Rather than coming in March, April, and May, people started getting fearful in February, around February 19th. Markets started falling and selling off, right? So you had a lot of fear around inflation. Fear around inflation started subsiding a little bit in the summer and then came back in August and September. And then in September, we had this combination of inflation fears with, oh no, what's the Fed going to do with the taper? Oh no, the Evergrande crisis, the market's going to collapse. And on top of that, the debt ceiling, the budget deficit, and the reconciliation infrastructure packages. Lots of fear. Or I should say lots of uncertainty leading to a lot of fear. If you look at those moments throughout the last year and a half, you can see the best times to buy were when fear was most extreme. Now, you look at the market. Why is it rallying? Well, there's no fear. What possible fear do we have now? Look, sure, we have an inflation report coming out next Wednesday, but look at what we got today. We got a jobs report that wasn't overly hot. It wasn't bad. It was actually slightly better than expected. And the inflation readings within it came in slightly lower than expected. So all of a sudden, it's like, wait a minute, what fear catalysts are left? And very, very few. And so in my opinion, until we have another big fear catalyst, we're not necessarily going to be in a type of market where we're going to have the best buying opportunities. Now, don't get me wrong, we're still going to have stocks that are red and green, right? Every single day you're going to have that. You're going to have stocks that went up 15% one day and then they pull back 5%. But then when you zoom out and you look at pricing, it's things have pretty much all elevated a chunk. Not everything, there's still some things that have lagged behind, but worth noting, right? I mean, look at this. The Dow Jones Industrial up 0.59%, the S&P up 0.42%, the Nasdaq up 0.22%, the Russell up 1.27%, the bond market down. All of these things are a representation, yields down that is. All of these are a representation of fear going down. With the exception of gold being up, because usually people see that as a fear-based metal, but I think gold has kind of lost itself as the sole fear hedge. So I prefer to look at the 10-year treasury and the 10-year break-evens. 10-year break-evens. But remember, yields go down when more people feel comfortable, generally institutions, when more institutions feel comfortable purchasing bonds. And if you think we're going to have a highly inflationary period coming up ahead, you're not going to buy bonds that are going to pay you 1.49% or 1.439%. It doesn't, gosh, we're down to 3.9? Holy smokes. We're basically at 1.44 right now. Wow, yields plummeted. So why do yields plummet? Because we're not seeing massive crazy fears of potential hyperinflation staying. And so the bond market's becoming more chill about the idea of buying bonds again. You get bond buying pressure, what happens? bond yields fall. Same thing we saw this morning on the 10-year break even. 10-year break even. We've come off some of the peaks that we had at the end of October. So anyway, things to pay attention to, but a lot of fear missing in the market, not a lot of fear catalysts left. And I think that's why we're seeing a pretty dramatically positive market, along with a bond market that is leading yields to fall. The way that works, of course, more people buy, prices go up, yields go down. So the question for you is it possible that Jerome Powell and this nomination or potential mystery around nomination will be the next big fear catalyst for the market, taking our lofty valuations and prices down a notch? Let me know what you think in the comments down below.